Hello guys, and welcome back to another episode of the MD Investor, the channel where we talk personal finance, setting goals, achieving goals, increasing our financial IQ so we can break the cycle of generational poverty. Welcome. Today's video is going to be a continuation of playing with fire. All about the FIRE movement. Financial independence, retire early. I've put the previous 3 videos in a playlist called FIRE. So you go to the channel header, you put in FIRE, and you'll see that playlist. Today's video is going to be another video about FIRE, sort of. Today's video is going to be all about the HSA. If you ever heard about HSA, it stands for Health Savings Account. And I truly believe this is one of those secret that only the financially astute, the financially intelligent people are aware of, and the rest of the people really they're not aware of. They may know about the IRA, 401k, SEP IRA, savings account, CDs, but an HSA, not everybody knows about it. So let's get right into it. What is the HSA? I kind of already said it. It stands for Health Savings Account. Almost like a savings account, but not really. They should probably really call it a health investing account. They should probably really call it a health investing account. Because a savings account makes it seem like, money in the bank, it just sits there. But after, you'll see in a minute that this is really more powerful. So it stands for Health Savings Account. Okay? What is it? A health savings account is basically an account that you are able to save money / invest money to prepare for future health needs. Simple enough, okay? So it's basically an account where you can save / invest money for future health needs, okay? Now, let's talk a few things about the benefits of this account. While you do your research, you're going to come across this term, triple tax efficient. Triple tax efficient. So the HSA, the money that you put into the HSA account goes in tax deferred. Just like a 401k or IRA, it's tax deferred, okay? So the government gives you a tax deduction for the money that you contribute. So that's the first benefit. You go in pre-tax or tax deferred. Benefit number 2, while it's in the account and growing, the gains like the dividends and the capital growth tax free. So that's the second tax benefit. And number 3 is if you take the money out for qualified medical expenses, it comes out tax free. So those are the 3 benefits of the HSA. So it goes in tax deferred, it grows tax free, and number 3, it's withdrawn for qualified medical expenses, tax free. Who is eligible for this magical account? For that, let's go into my computer, and I'll see you over there in a minute. In my computer. So we've been talking about the HSA, Health Savings Account, triple tax benefit, triple tax advantage. The money goes in pre-tax, it grows tax-free, and then it comes out for qualified medical expenses, tax-free. Sounds like an awesome plan. So how can I get a part of this? Who's eligible? First thing you have to have is a high deductible health plan. You have to have a high deductible health plan. So this is strictly directly from the IRS. For calendar year 2022, a high deductible health plan is defined as a health plan with an annual deductible that is no less than $1,400 for a single person and double $2,800 for family coverage, right? In addition, the annual out-of-pocket expenses for deductibles and co-pays and so on cannot exceed $7,050 for a single person and $14,100 for family coverage. So you need to have a high deductible health plan. That's one of the requirements. You also can't have any other form of insurance. You can't have any other form of insurance. So that's one of the qualifications. Okay? If you realize most of your insurance is going to be traditional insurance would be lower, they're low deductible, right? Very low deductible. These are very high deductible. So let's look at some of the medical expenses. Actually, before we look at the medical expenses, let's look at some of the maximum contributions. Right? So we know what high deductible health plan, we just talked about that, one of the requirements, but let's look at the maximum contribution. Annual contribution limit for 2022 for single person, single plan, maximum contribution is $3,650. For 2022, maximum contribution for adults, of course not adults, for family, $7,300. That's the maximum. Let's look at some of the qualified medical expenses. Right? Over here, what medical expenses are includable? What's covered? What's considered qualified? Everything here. And they basically go alphabetical. Abortion, acupuncture, if you have alcohol abuse, and you have to go to a rehab center, if you take an ambulance ride, annual physical examination, you have a prosthetic limb, artificial teeth, bandages, birth control pills, body scan. I mean, there's a lot of things. Braille, if you're visually impaired, Braille books. You have breast cancer, you have breast reconstructive surgery. Those are all considered qualified medical expenses, right? Chiropractor, contact lenses, crutches, dental treatment, right? So don't forget dental treatment as well, okay? Drug addiction, if you have to go to like a rehab center, of course your medication, your prescribed medication, and some over-the-counter stuff too, right? Like your allergy medication, your eye exam, eyeglasses, fertility enhancement. So there's a lot of things here that are considered qualified medical expenses. So after you open up your HSA, right, you have an option to invest, right? Even though it's a savings account, health savings account, it's probably better termed health investing account. Again, we're on the Fidelity site, which is one of this custodian. There's other companies out there too. Triple tax advantage. That's one of the things they always tout. Triple tax advantage. Pre-tax or tax deduction going in. It grows tax-free. And if you pull it out to qualified medical expenses, tax-free. So that's where you get the triple tax advantage. It's investable. So it's not like a savings account. It's investable. You can invest it in like stocks and bonds and ETFs and so on. It's portable. It is your money. As opposed to a flexible spending account, which sometimes people get confused, which you have also for qualified medical expenses. But if you don't use it, they say use it or lose it. Whatever you don't use at the end of the year, you lose it, and then you start the year over. With the HSA, if you don't use it, it carries over until the next year. So that's a little different. Also, your flexible spending account belongs to your employer. If you leave your job, that doesn't go with you. With the HSA, it belongs to you. If you leave your job, it comes along with you. Okay? Let's look at a compound interest calculator. I use this because you may have some money in cash, right? And you may have some money invested. Let's go through an example. You have set up an HSA account, right? You looked at it, you studied, and you realized, you say, this could benefit us. You have a family. So $7,300 is your contribution max for 2022. You put in $7,300 divided by 12 is about $608. This is what we have here. So you're doing $608 every year, right? Say you're 30-year-old. You put your $608. The very next month or very next day, you have an accident. You have to go to ER, and the bill from the ER is say $5,000. $5,000 is more than you have in there. You only have $608. The benefit of that, you can use another source of payment. You can pay them with, your credit card. Of course, you're going to pay everything pay everything before the month is over. You're not going to carry a balance, and then you can reimburse yourself when the money's in there. There's nothing in Irish law that says you have to reimburse yourself that year. So what a lot of people do is they delay the reimbursement. As long as you keep good record, right? You have the HSA custodian, maybe Fidelity or maybe one other company. You have your receipt, you upload your receipt, saying will it have the date, the time, the vendor, the hospital or whatever. But you don't take the money out. You let the money grow and compound tax-free. And in 50, 20, 30 years, then you submit it and then you get reimbursed, right? But now the account has grown so much. That's one of the wealth building tools. Let's go through this compound calculator. So monthly, $608 every month. We do it for 35 years. Say we put it in the S&P 500, we get an 8% return. This is what we'll have after 35 years. We would have contributed $211,000, and our growth would have been $829,000, right? And our total amount that we'll have is about $1.4 million that's here. Most of it is growth. So it's a personal thing, because if you're a person that has chronic illnesses and you go to doctor and hospital a lot, the high deductible, which could be $5,000, $6,000, $7,000, may not be something that you want to do before the insurance kicks in, right? But if you're a healthy person and you know that we really don't use the health system that much, and with the high deductible health plan, your premiums will be lower. So with the money you're saving in your premiums, you could be investing that, and it could be growing and compounding, and we take it up qualified expenses. We could be ahead of the game. So, but that's something personal that you have to look at. Other thing you want to keep in mind is that after the age of 65, you can take it out, and it can be for non-medical uses. It can be just for your regular retirement. Of course, at that point, because it's for non-medical, you'd have to pay ordinary tax as ordinary income. But like I said, God, it's a great strategy to use. And again, it's just one of those things we're trying to increase our financial IQ, because for a long time, I didn't know. I knew about Roth, I knew about traditional and 401k, but I didn't know about HSA. It's something to look into. You probably have to call your human resources department and say, do you guys have a high deductible health plan option? That's something you may want to research and look into. And if you do, something you may want to consider, because in addition to your Roth, your traditional, your 401k, and now you may have a pot of money set aside in your HSA. You see how now it can become, part of your bucket or pool of money for retiree, guys. Don't forget to subscribe, guys. It's MD Investor on YouTube. Don't forget to subscribe. We try to put videos out twice a week, Mondays and Thursdays, so we can increase our financial IQ and break the cycle of generational poverty. And until next time, command your money to grow. MD Investor out.